had solicited to her. And at that time, Cheryl was in a class getting her designation for reverse mortgages. So the day that she came out of that class, we presented it to my grandmother and she got a reverse mortgage. And it was pretty cool. So today, Matt is going to give us the myths and the misconceptions of reverse mortgages and how they actually work for our seniors. Good morning, Matt. Thank you for coming. I would like to see, how many people we got here this morning? Oh, Mr. Farmer, good morning. How are you? Let me hit the record button so that everybody will be able to get this session if they need it. But yes, Mr. Matt Hilton is here with us. He's from Nashville. Your office is located near Nashville, Matt?
Yes, ma'am, Miss Sharita. I'm just outside of Nashville, but have gas, will travel. So that's where I met your team in beautiful Memphis at the Peabody.
Yes, sir. So how did you get started with reverse mortgages?
Sure. Yeah, thanks for asking. And if I could you maybe share with us before we go too deep about what the reverse mortgage did for your grandma? How did it help?
My grandmother had a house in Collierville and it had been paid for probably for 20, 30 years. And when she got her check, they came out to her house and wrote her a check for $160,000.
Mm.
The first thing my grandma wanted to do was buy a black Escalade. And she asked Cheryl, she bought it online. She called them and said, "Hey, I need a black Escalade. I needed to have this, and this." And it was so easy. The process was really easy. They got the information on one day, and maybe 2 or 3 days later, they were out at the house signing the paper, gave her the check right on the spot.
Wow, that's awesome. I might edit that out because it doesn't happen that way in today's
I
world.
know it's totally different now.
But still, that's awesome. That's a great example of the reverse mortgage can be a tool to satisfy needs, right? So we pay some people's
Hmm.
taxes, some people's insurance, give them money to buy groceries. Some
Hmm.
people, we show them how they have a huge portfolio, they can use their equity to make their portfolio last longer. And then
Hmm.
some people can use the reverse mortgage to satisfy wants, which an
Hmm.
Escalade I would classify as a want, not a need. But you haven't worked for, 40, 50, 60 years to pass away and not have some of your dreams come true. So that's pretty awesome that she used it to. I'm assuming Escalade was one of her bucket list items if she fulfilled it that quickly after the closing.
Actually, my grandmother was over the top. She was exotic. And that wasn't her first Escalade. That
Wow.
was maybe her second one. But it was because different things were happening in her life at that time. And she wanted to do something totally different. And so
Sure.
once she got that money, she just was like she was in her 30s. She got to spending and doing all kind of things.
That's awesome. Well, thanks for sharing, guys, and thank you so much for having me. Um, I guess a little bit of way to get to know me is maybe share a story with you is how we got into the reverse mortgage space where I got in the mortgage business in 2006. As you could guess, great timing, right? You knew what was on the horizon after 2006. And I had really enjoyed giving people their first set of keys, right? I'm sure a lot of you guys either are or work with first time home buyers, which is fantastic, right? To here's your key, start building wealth, you're on your way. That's a great feeling. And then later on in my career, I got a call from one of our clients that about, I don't know, 15 years before we got her into a 20-year mortgage. So she called and she said, Matt, I don't know what I'm going to do. So what's going on? She said, well, my mind and body is telling me it's time to retire. Unfortunately, my bank account and my social security check that would be coming in if I do retire is telling me I'll never be able to retire. What do you think though? Because that loan you did for me years ago, I only owe 20,000. You won't believe it. My house is now worth like 500,000. She's like, so what do you think? Maybe could we do a cash out refinance? Could we do a HELOC? She was going through and we ran the numbers, and she was going to have a huge monthly payment, right? If you borrow two, 300 grand, even if rates are down, you're going to have this big payment. Well, her Social Security was only going to be about 30 grand a year. So as you could guess, it's hard to live off 30 grand a year, let alone if you have a $2,000 a month mortgage payment. So I said, you know what? There was a couple of programs I did years ago. Let me re-engage with that, and let's see if this will work. So we went to work for her. We paid off her mortgage, which she was currently paying about $1,100 a month on her mortgage. So we paid that off. That went away. So her mortgage payment went from 1,100 to then zero. So that was a
Mhm.
huge help. And we were also able to give her $100,000 in cash. Uh, So that was a big help. And then we were able to give her $100,000 line of credit. So as you could guess, if you're making 60 grand, but your bills go down, you have a lot more money in the bank, you feel a little bit more comfortable going down to 30 grand. So after we got closed, she finally saw the money. She didn't go buy an Escalade like I heard some people do. But what she did was she turned in her papers and retired, and because she was able to survive off 30 grand when she didn't think she'd ever be able to retire. And at that point, we were like, man, there's something to this thing. And then we went all in and built a YouTube page and built a podcast and hired staff to go all in. And we've just found that our goal is really just to help people not just get by and survive, but thrive in retirement. And from that one experience, it's been awesome. And that's kind of why we do what we do.
Awesome. Well, my grandmother also did some repairs to her house and she lived on the rest of the money.
There
So,
you go. I was hoping she didn't buy the $160,000 Escalade. At least she,
yeah.
maybe got around 100 and saved some of that money for other stuff. That's great. Well, if you guys are okay with it, I know that we have a mixed audience. I have some information that I share with realtors at our CE class. I have some information I share with consumers. And then I also know that some of you guys may have some questions. So, um, if you guys wanted to, maybe Sharita throw out some questions, or if anyone has any questions, what I was going to do is take some notes to make sure as I jump around, I hit all your questions. If anybody's open to unmuting and sharing a question, I'll write it down.
Yes, Lydia has a question. She put it in the chat. She wanted to know what is the turn time and is the homeowner responsible for taxes and insurance after the loan closes? And
Okay.
what happens to the half after they die?
Okay. Insurance. Yep. Okay. After they die. All right. Great question. I'll make sure I cover that. What are the questions that people have?
Or what are the qualifications of getting a reverse mortgage?
Okay. Applications. Fantastic. All right. We'll definitely hit that. Anything else?
Not at the moment.
Okay. Perfect. We'll make sure we cover that. And what I was going to do, if it's okay, is maybe get into those details, but I'd love to share with you kind of, if you're not a senior, some of the reasons why this is becoming a better option for seniors, and I guess kind of the way seniors are thinking in today's world, just some of their concerns. You guys see that there?
Yes.
So this is kind of the conversations that we have with seniors, and you kind of walk through, here's how we can help. And longevity is super important. As you see, ensuring families don't run out of money. You would think that the number one concern for a senior is dying and passing away, but unfortunately, that's not. The biggest concern when you poll seniors is this one right here. What if I live, but I outlive my money? And that's been one of the biggest concerns. So that's one of the things we talk through. Hey, how can we give you more runway? How can we help your money go longer, or how can we help you stretch what you currently have? So we talk a lot about that. And then if they've got that covered, then we talk a lot about lifestyle. So, hey, got it. You've got it, enough money till you die, it looks like. but are you having the type of retirement that you want to have, right? It doesn't make sense that you've busted your rear end for 40, 50, 60 years just to get by at the end, right? So is there any way that we could help you with your lifestyle, whether it's, and as you know, some people have more extravagant lifestyles. Some people just, if they could go out to eat once or twice a week because they can't afford it now, that would really add to their lifestyle. That makes, so we talk a lot about that. The third L I call is liquidity. So another thing we talk to folks about, what if things don't go the way you want it to go? Let me see a show of hands. Who knows that the finances always don't go the way you had planned, right? Sometimes things happen outside your control that affects your finances. So that's what we can do is we can actually, this program can give people access to liquidity, access to their equity to have it on a rainy day. So we can talk more about that. But what we see quite a bit is I had for example, I had a client that he called and he said, "Oh my gosh, I can't believe that you actually answered." And then he said, "Do you do reverse mortgage?" I said, "Yes, we sure do." He said, "I can't believe I actually found you." So what do you mean, sir? He said, "You're the 22nd bank that I've called and everyone said no."
Right.
So he actually called 21 different bank branches, and then a friend of mine is the loan officer at the bank. They don't do reverse mortgages. He gave him my number, and we were able to help him. But he was so motivated because his wife had dementia, and it wasn't just lay around and have dementia. She was mobile dementia, so she would rummage through the everything in the bathroom, everything in the bedroom. She would basically take off, be going through things. And he was 80 years old, and he knew if he broke his hip chasing her, they'd be in real trouble, right? So, for example, what we did with him, we were able to unlock a line of credit where now he can actually pay for in-home care, where he's still there, he's still of sane mind, he's good shape, but now he has people that can come over. They're about $30 an hour, some are $50 an hour to be able to professionally work with his wife. So he's able to use his house so they can stay in their house. And then we talk about the final L is legacy. That's where if some people are good, they're going out to eat, they're having fun, they're able to go on vacation, but they've got this great plan of leaving a bunch of money to their family, which I think that's great. I hope we all get to that point someday where we can leave money to our heirs. I always tell people, I don't like that plan. And they always say, "What do you mean, not giving money to the kids?" And I say, "Well, there's one big thing about your plan I don't like." And well, they always are all huffy about it. It's like your plan to work, you have to die. And I don't know about you, but any plan that has me dying is not my favorite plan, right? Hopefully you guys feel the same way. So legacy is actually some people have all this equity they leave to the kids, but we can actually help them get some of the equity now. And I say, do your giving while you're living. You can actually give money to the church, give money to the family, give money to the grandkids, and be involved with it and actually see it grow. If you give money to the church, work with the kids. So we talk a lot about you could leave a legacy instead of wait until you're dead, if that makes sense.
Mhm.
So I don't know if that spurred any questions from anyone, but I call those the four L's. That's a lot of our conversations are based off that. Hope that makes sense for you guys. And
Yes.
then, and then what I want to do is hit a few. We talked about myths and misconceptions. Let me see a show of hands. Who's ever heard that don't do a reverse mortgage? They're going to steal your house, steal all your equity, and they are the bad guys. Everybody raise their hand. I'm sure you've heard, some people have heard that before. That's a lot of the misconceptions are that people lose their house on a reverse mortgage. So I've got a slide for you on that. There.
Matt, also another question was,
Yeah.
can you owe the IRS have a debt with the IRS before you can get a reverse mortgage?
Ooh, good question. Uh, IRS. I was just working on one like that earlier. IRS. Okay, perfect. I'll hit that as well. Can you guys see the slide here, the misconceptions?
Yes, it's kind of small. You can make it a little bit
Show
bigger.
Your wish is my command. How's that? Is that better?
Yeah, smiling.
All right, here we go. I'm going to go back there then. I'll stick with this if that's all right. So a couple misconceptions that we run into. Number one is a lot of people say that your home must be debt-free and completely paid off to qualify. So that would definitely be a misconception because one of the big advantages is cash flow of this. We had a client. He was a part-time pastor and a part-time cleaner. He'd had contracts for his entire life cleaning businesses, and um, he had a $1,500 a month mortgage between his part-time pastor, between his cleaning business and Social Security. He was only making about $4,000 a month. So you guys
Mhm.
can kind of see the problem here, right? You got 4,000 coming in. You're 65 years old. You're still working nights cleaning. You're still being a pastor on Sunday. You get little Social Security. And when your 4,000 comes in, you immediately have to turn around and write a check out for 1,500. And if you guys have owned a home before, the mortgage isn't the only bill, right? So then you got your light bill, you got your water bill, and I don't. If you guys are like me, every 2 to 3 hours I have this bad habit. It's called eating that I have to do. So that gets expensive, right? So you have all these bills. So he was cramped on his budget. So this is a big misconception because the benefit to him was we came in, refinanced his mortgage, so paid it off. His $1,500 a month mandatory payment goes from 1,500 down to zero. He didn't have to send in another pay. Now he can in today's world, you can make payments. He just didn't have to. But his home was worth almost 500,000 and our loan was only 150,000. So it didn't really make sense for him to make payments because he had all this equity. So if you follow me, his monthly cash flow increased by $1,500 a month. And I'm sure everyone on here, doesn't matter how much you're making, if you have an extra 1,500 bucks a month, that's going to change your world, especially if you're only making $4,000 a month in his scenario. So that would be a misconception. Your home does not have to be paid off. A lot of times we pay off a HELOC, we'll pay off a mortgage, and that's a big help for seniors. Another misconception is that the borrower feels and they're worried that their heirs are going to be left with excess debt. So they're worried, it doesn't matter which channel you guys watch or seniors every day, whether they watch CNN or Fox News, it's just a different twist on death, destruction, war, famine, real estate crashes, right? It just everything, it's all concerned about scaring everyone, including seniors, take that more than other people. So that's a big benefit on this is that they don't have to worry about leaving their heirs with a big debt because now in today's world, especially in most of the states that you guys would be from, these loans are 99%, in some states even 100% FHA mortgages. So I'm sure you've all had clients do FHA, right? First time home buyer. Well,
Yes.
FHA decided, hey, we need to help people get into homes, but we also need to help folks once they're in the home. How do we help them stay there? How do we help them thrive in retirement and have cash flow? So this is the other side of FHA. It's called the HECM, Home Equity Conversion Mortgage, HECM. And the power of it being an FHA mortgage is some of you, if you're on the traditional side, may talk about, hey, let's try to avoid mortgage insurance. Well, that's because it only helps the lender and bank. In these scenarios, there's actually mortgage insurance on these loans, but it actually protects the borrower and it protects their estate. So this is a misconception of borrowers are going to have excess debt on their home. That's not true because let's say that the balance of the loan goes up and the real estate value crashes. So just rough numbers, if they owed 250 and maybe the home has some big damages, maybe the market crashes and the home's only worth 200. You follow me? So they owe 50,000 more. Sharita, you may call it a short sale, back when you were selling homes in 08, 9, 10, 11. That can't happen in this scenario. So meaning that if they owe more than the home is worth, FHA would step in and pay that $50,000. the senior never passes worrying about passing on that $50,000 to their kids. You guys catch that? So meaning that the mortgage insurance would pay the excess liability if they ever upside down on their home. So that's a big change where back in the old days, you could owe more than the house was worth, and they'd come after you, come after your family, come after your estate. So that can't happen. So that's a big misconception. That's all taken care of now. A third misconception, and the realtors love this one. They used to be worried that the consumer or clients will never be able to sell their house, and that's not true. So the way this works is the senior still owns their house. They have complete control of their house, just like any other mortgage. So the senior owns their house. They just have a mortgage on title. They could close the reverse mortgage one day and change their mind and turn around and sell the house the next day if they wanted to. So no different than a regular mortgage. So that's definitely a misconception. Seniors can sell their house whenever they want. The third misconception is the lender takes ownership of my home. Lender takes ownership of my home. So just like a traditional, I'm sure you guys all have some clients that pay cash for homes, right? But you definitely have clients that take on mortgages. These are just regular FHA mortgages, no different, a little bit flexible on the payment, but as far as all the rules, being able to sell the house, being able to move, who owns the house, the senior owns the home, they just have a mortgage on the house, no different. So that would be a misconception. And this would be a fifth big misconception we run across is that it says reverse mortgages are only used as the last resort for seniors that don't have assets. So some seniors do use this for those type of things. We heard a very good story about how seniors can use these to buy luxury vehicles earlier. So that's one thing. But to give you an example, I had a client. Um, I had a client, they had $2.5 million in their portfolio. They were 82 years old and they got connected with a 75-year-old. Both were widowed and she was actually born and raised in Florida, but they had migrated to Tennessee and they met on, I don't know if you guys have been on that website. I'm not sure if you guys go, it's called Silver Singles That Want to Mingle. I don't know if you've ever been on that one, but they definitely got connected online. So she wanted to get back to Florida. So what did they do? Well, he was concerned that if they did a regular mortgage on a $850,000 home in Florida, unfortunately, the men always 99% of the time die before the ladies do. And especially he was 82 and she was 75. So his concern was, hey, I'm giving my money to my kids because we just got together recently. I love you, but you're 75, I'm 82. My kids need this money, but I can't leave you with a $5,000 or $6,000 a month mortgage. How do we solve this? So we actually did a reverse mortgage purchase for them. Our team did in Florida for them. So meaning he put half of it down. He did a reverse mortgage for the other half because he knew if he passed away, she would be able to pay zero on the mortgage, and with just her Social Security, she'd be able to afford it. If that makes sense. And he also was really good at investing. So instead of him paying cash for the house to have no mortgage, he'd rather keep the other $400,000 in his investments because he bought and sold houses, bought and sold stocks, and wanted to use his money. So we definitely have folks that have higher net worths and higher incomes that do these as well. So no, that was a bunch of stuff there. I want to stop and see. Did that bring up any questions in the chat, Sharita, or anyone else have another question to add in?
Yeah. How long does it take HUD to pay the claim? So those
Okay.
are kind of like what 5 or 6 of the questions that we have
Yep.
for you to answer.
Perfect. Okay. I got
I,
that.
I, I wanted you to talk about the investment portfolio that a person can use the reverse mortgages on.
Okay. Perfect. Why don't I hit, we're still good on time. Why don't I hit some of these questions here and then feel free to put some more in the chat or pass some questions on to Shrita if that's all right.
No problem.
So we had a couple questions about turn times. Um, So if you're not in the real estate world, that's basically just how long would it take somebody to close, right? From start to finish, how would you get to the finish line? So a lot of places will have to say like 60 or 90 days to close a reverse mortgage. Our scenario is a little different. We have our own team of we have our own underwriter, processors, all that only do reverse mortgages. So we can move a lot quicker. So we're usually about 30 days on the refinance side. And then we can talk more about for the realtors in the room, the reverse mortgage for purchase. And those we can move them as quick as you need to move them. You know, if you had a 21 day reverse mortgage purchase scenario, we would do our best to do that. That is possible. Um, as long as there is a precursor called counseling, which I just call a class. So your senior has to go through reverse mortgage counseling, which it's just an hour and a half phone call with a HUD certified counselor, similar to, I'm sure you've had clients do like THDA mortgages and they have to do the home buyer counseling or home buyer education, similar to
Mhm.
that. So the senior has to get on the phone with someone for about an hour and a half. So if you're an agent and your client's interested in a reverse mortgage purchase, that's just one extra thing for the pre-qualification is those are good for 6 months. So that would be a positive to speed the process up where if they could do that in advance before they go under a contract, that would give you your best chance of a, 3 to 4 week purchase closing. But yeah, they're not
Mhm.
the challenge, right, is they're not that much different than regular loans, but if your company is kind of dabbling in them, meaning that your underwriter that's doing FHA, VA, conventional, well, if they have a reverse mortgage in their stack and they've got all these other files to close, and they have done, they did a reverse mortgage like a year ago or a year and a half ago, and they have to relearn the guidelines and look it all up. And then all the other loan officers like, hey, why aren't you getting to my file? And after a while, the reverse mortgage can kind of get put to the side. Does that make sense? So that's why we have our own, just a single track just for reverse mortgages. That way, A, there are people that do it every day, and B, they can move them quickly. So those can move fast in our setup. And then you mentioned about taxes and insurance, I think was a question. So the property performs like it's paid off. So we get that a lot. It's like, well, don't I still have to pay taxes and insurance? It's almost like they a gotcha question. Hey, well, you said I don't have a mortgage payment, but I still have to pay tax and insurance. Well, I usually just say, well, if you had your home paid off, would you have to pay taxes and insurance? And they usually say yes, right? So basically, your home just acts like it's paid off. So you pay taxes, you pay insurance, and you pay HOA dues. Now, there is a caveat to that. If you sometimes to get the loan done, we have to it's called a Lisa, which you would probably call it an escrow account, meaning that the loan has to be responsible for the taxes and insurance. And how that works is we would look at it if they have low credit scores or they've had trouble paying their taxes and insurance, then the last thing we'd want to happen would someone to lose their house for the tax man. Um, and the reason why they do this is as for bad press, right? No one's going to have the tax man take their house and be happy about it. So we want to really protect those people if they have trouble paying their bills. So what would happen is, like say if we could give someone 75,000, we had one in Jackson where we could have given her 75,000, but the lady had a 426 credit score. That was, I'll say it again, 426 credit score.
Mhm.
So she couldn't be held responsible for tax and insurance. So what we did was we were able to give her 50,000 and then we left 25,000 in the loan. And then every year the loan sends off 1,000 to taxes and 1,000 to insurance. Thousand, and the loan goes up a little bit, but the loan pays the taxes and insurance. So that's a way that we're able to get around low credit scores. So there is no minimum credit score on this, and it's also a way we're able to get around debt to income ratios as well compared to normal loans. It's real flexible, but back to taxes and insurance. So if you have good credit, normally people will pay them on their own. If you have tougher credit, a lot of times we have to pay that outside of the loan, if that makes sense. And then I believe the other question was, what happens after they pass away? So the way it works is they've got the guidelines say that you have 6 months with a 6 month extension. So most people, a lot of people do take the full 12 months to satisfy the debt. So if someone passes away and they have a reverse mortgage, the house just follows their will, it follows the trust, goes through probate, whatever they have set up, just like any other mortgage, when they pass away, it works the exact same way. So if the house someone I'll give you an example. If someone owes 100,000 on a reverse mortgage, say the home is worth 300,000 and they have two kids. So
Mm.
they pass away, then they have to figure out what are we going to do with the 100,000. With the extension, they have a year to do that. And the only way they could get in trouble as far as risking the house or different things is if they didn't respond, just like anything. If you go ostrich, stick your head in the sand and try to hide from something, it becomes a problem. But as they get letters in the mail, all that kind of stuff, they have a year to figure it out. And they would have the ability, if they owe 100,000, there'd be a few things. Number one is if they have the money or if there was life insurance, they could just pay it off. Then the home's free and clear. They still own the home. They own a free and clear house. Number two is maybe one of the two kids want the home so they could get their own personal mortgage, pay off the mortgage. Because remember, they own the house, so it'd be a refinance because they've already owned it. Mom passed away, it's gone to their name. Refinance it and then either move in or use it as an investment property. 90% of the time, the kids don't want mama's house or grandma's house. What's the kids want? They want the money, right? So in
Mhm.
that scenario, one of the agents on here would list the home, sell it for 300, you know, the payoff would be 100. So you clear 200 and each kid would get $100,000. That makes sense. So it works just if you've ever sold a home that where someone passed away, it works the same way. Just the only difference is it's not a forever to figure it out. Um, you need to figure it out within 12 months or so.
Mm.
So that was one of the questions. And then another question came in about qualifications and how that works. So as far as the qualifications, the biggest one is age. So in the state of Tennessee, we really only have one option. You have to be at least 62 or older, as well as most of the other states in the area. The well, we used to be considered a low price state, as you know. Everything's gone up, but still compared to California and Florida, we're still cheaper price of housing. So you have to be 62. Some states have options as low as age 55 for you would call them probably portfolio options. And then the other qualification would be I just it's kind of a sliding scale. So I always just say you need to have a large amount of equity, and it usually makes sense for us to at least look at something if people have at least half equity in the home, and then it's based off their age. So if you're 62, you can usually only borrow 25 or 30% of the value of the home. And sure, that's one of the things that's probably changed since your scenario. Back in the old days,
Yes.
you could borrow, 75, 80%. Well, what happened in 2008, 2009, if you borrowed 80% and your house goes down by 30%, then FHA was left holding the bag with a bunch of these insurance claims. So what they wanted to do is they don't want to pay those, and they also always want you and your family to have equity if at all possible. So if you think about it, if you're only 62 and you borrow 30%, so If it's a, $300,000 home, you can borrow close to $100,000. Well, even if you live 10, 15, 20 more years and you never make a payment, your balance goes up. Remember what's going on with real estate, right? House is still going up and you still get to benefit on all that equity on the upside. So that's why they start with low amounts. Now, if we're working on a couple now where people are 80, 90 years old, they're probably able to borrow 40, 45, maybe 50% of the value of the home. So the older you are, the more you can borrow. Does that make sense?
Well, it doesn't make sense to me because the older you are, the closer to the end to me. But
Yep. And the
why would you let them borrow more money? And that's where the myth, I guess, like, comes in, is that they're expecting them to die and they retrieve the house because, they're borrowing more money than what they probably even need
Sure.
at
Yeah.
50%.
Makes sense. Yeah, so I guess the probably the non-politically correct way of saying it would be that they're gonna die sooner. So if
Right.
it's a $400,000 home, and let's say they're 95 years old, maybe we could give them close to 200,000, but
Mhm.
there's not a lot of time for the interest to build up. Does that make sense? So they
Exactly.
borrow 200,000, they only live for a year, they owe 205 or whatever the number is. Does that make sense? But a 62-year-old, if they borrow 200,000 and they live 30 years, they may end up owing more than the house is worth, is the way that they look at it. So that's
Right.
that's why it's that way.
The-
But that's the reason why that's probably our biggest challenge is a lot of times people will call and say, "Hey, I've got a lot of equity. I heard you're the person to call. Can you help me?" And say, "All right, tell me how it works." Well, I'm 65, I want to retire, I owe 200, and my house is worth 400. It's like, well, you are correct. You do have a lot of equity. That's 200,000. Unfortunately, at age 62, you have to have, or 65, you have to have more equity, right, to do this program. And that's where I'm glad I'm on this because I need to know, have good contacts around the state because we'll get those calls and we need folks that can do HELOCs and folks that can do traditional financing in those areas because maybe that person needs to pay off their mortgage and borrow an extra 50 grand. Well, that wouldn't be an option with this program because we would be stuck at around 125 $130,000 loan. If that makes sense. So those are all. So that would be qualification would be based off your age, based off your value of your home, based off how much you owe, based off how much you owe. And the last thing is what's going on with interest rates. What's going on with interest rates. So that's why I think I saw a message. There's really no, I can't just send you, hey, if you're 65, you can borrow this much because it also varies with rates. So if rates are higher, you can borrow a lower amount. If rates are lower, you can borrow more. So it's a sliding scale that changes every single day.
Sounds like it's really individually based.
Yep.
Um, and there's no real scale that you can actually format for an average buyer
There's some fact
or
there's
an average
there's some
person that wants to
factors.
do a
Yes,
reverse
ma'am.
mortgage.
Yeah,
Yeah.
there's some factors, percentages, but then they're actually changed by what's going on with rates. And then sometimes, depending on how much they owe, the first part of it has to go to pay off the mortgage, and then the rest of it can
Mhm.
go to them in their pocket. So good question. But really, on y'all's end, just so you could see if you could ever help anybody that would make sense to talk to, would be, are they 62 or older? Do they have a good chunk of equity? If that's the case, it may be something that they could look into. Yep.
Yeah, I don't mean to make this personal about me, but my aunts and uncles are 62 plus. And every year they ask me about a reverse mortgage because they keep thinking about what my grandmother did.
Okay.
And so to me, and like I tell them, I say it's totally different because her house was paid off. She
Yep.
didn't have a mortgage. And all the money that she received was for her to live off of, in
Mhm.
addition to her monthly check that she got. But she
Yep.
didn't have big debts, but she owned a lot of properties. And if
Okay.
that at that time they didn't we didn't know about the investment part of it, where she could have got the equity out of the other homes as well to
Mm,
suffice whatever she wanted to do at the time. But
good,
yeah,
good
yeah,
question.
it seems like it's individually based, most of
Yep.
it.
Yeah. So I think someone asked a question about how could I identify a possible candidate? Really, if you think through it, my opinion is if they're 62 or older and they have at least half equity, 50% equity, it may make sense to at least chat with them about it because if rates go down, then we maybe could be able to get close to that. Does that make sense? And sometimes it takes a year or two for people to learn about it, get educated on about it, feel comfortable with it, and see. So that's those are my generic numbers. I think someone asked that question is if 62 or older and you have at least 50% equity, it may make sense to at least start learning about it. One,
About the IRS debt.
yep, as far as IRS goes, the if you're on a for example a payment plan, then we can actually add that in as long as you've made probably similar to some loans you've done, right, traditional, as long as they've made three payments on their payment plan. We could use that, and then you can also pay it off with the money you get from the loan, as long as if it's a lien on title, you could pay it off.
Mhm.
Now if it's just I just filed my taxes, my liability is 5,000, then you can't pay that off with it. You would have to figure out a way to pay off. So what we do a lot of times with those is, let's say that you, just to give an example, if you're a real estate agent, you're 65 years old, you filed your taxes, you owe $5,000. We start looking at other options because we don't always have to send in taxes. All we have to do is send in enough money to pay to show that you qualify to pay your taxes and insurance and HOA dues. So a lot of times people will have a little Social Security coming in, they'll have a little this or a little rental income, and we don't even tax your tax forms that show how much you owe is not even a requirement to send in on this. Now, if that's your only income, then we have to deal with it. We have to deal with it. But that's where all we would do is you could set up a payment plan and we would just have to wait 3 months probably because you could set up that payment plan. And once it shows you've made three payments, that could be an option. Did that answer the IRS question? Any follow-ups to that?
Yeah, that answers it.
And then someone asked about paying the claim. So the way that works would be if you were upside down. I think the example I gave earlier would be house is worth 200, you now owe 250 for either the market crashed or maybe the roof blew off and you didn't have insurance and now it's worth less because the market. So what would happen, these are non-recourse loans. So what that means is they can't go after the senior. They can't go after the senior's family. The only thing that can be used to satisfy this debt is the house. So in that scenario, you really wouldn't worry about timing of paying the claim because, let's just say it was you, your parent had passed away. They did an appraisal. They said the home was worth 200. You've got a statement that shows that they owe 250. You're working with the lender and say, "Hey, looks like we're upside down. Here's the keys." And then it becomes their house at that point because you'd give it back because there's no money to be made. But there is
Give
a
it back to the lender.
yes, ma'am. Uh-huh.
Okay.
Because it would be upside, it wouldn't do you any good. But there is a caveat to that. Let's say that someone in the family wanted the home. This is really cool. They could actually buy it at 95% of the appraised value. 95% of the appraised value. So if it appraised for 200, they owe 250, they could buy it from the lender at 95% of the appraised value. One of the left family members could. So they want to keep
Mm.
properties in the family if all possible. And then
All
if you
right.
think about it, you're like, a lot of people will say that sounds a little risky. The house is upside down and they owe more, and that sounds messy. Well, think about the other option. So let's say that the senior thought their home was worth, let's say the senior had like a 30-year fixed mortgage. They paid on it year after year after year after year, and they paid it down. They thought it was worth 400,000. They were super excited about giving it to their family. They make, if it's they maybe borrowed 200, by the time they make all their payments on it, they've paid 300, you guys have seen the amortization schedules, right? That's kind of scary how much interest you pay. So the senior made all these payments on this asset they thought was worth 400. Somewhere, either when they passed away or after they passed away, the market crashes and all that equity they thought they were giving their kids disappeared. They made all the payments and the equity vanished. In this scenario, the senior would actually get to use the equity, and then they're not on the hook for it. Their kids are not on the hook for it. FHA is. So it actually turns the risk the other direction, if that makes sense. So some people would say it's riskier not to put one of these in place, because then if the market crashes, you lose all that equity. So just different way of thinking about it. And then
Evening, but yeah.
what's that?
I said it seems confusing, but I guess it's a it's a different way.
Yeah, because think about, so if you have a family member that makes 30 years worth of mortgage payments and then the
Mhm.
market crashes, they thought they were building equity and then it's gone, right? So say you made all your payments in 2008, 2009, 2010, you pay all this money and then the equity's gone. And then, or the families back then, right? Those were short sales. The families were on the hook for that decrease. In this
Mhm.
scenario, if your equity evaporates, you're not on the hook for it. This is a non-recourse loan. FHA is. So you move that risk to them instead of the family. That makes sense. So that works out good. The other thing you mentioned investment. So this is another change. What people do is you actually these are FHA mortgages. So you have to do it on your primary home, just like any other FHA mortgage. So they can only do the reverse now on their primary, but like in your mom situation, she could have pulled that money out and used it to buy other homes. Does that make sense? So she could have invested in real estate. She decided to invest in a car, but she could have invested in real estate. Does that make sense? So we'll have people that'll have a paid off home that'll do one of these loans to either get the down payment or to get some money to buy a rental home or buy a vacation home. And then they own two pieces of real estate instead of just one.
Right. I thought earlier you were saying that an investor who has a portfolio of,
Yep.
several homes could actually do reverse mortgage on those particular properties.
So they would be able to use the money to acquire properties, but you would do the actual loan would be on your primary home, on your
So
primary.
okay, I got you.
Yeah. So you can use it to wheel and deal, but the loan would be on your primary home. If that makes
Yes,
sense.
sir. Okay, well, we got about 8 minutes left, and we got a few other questions in the chat. Let me see. What are the major caveats of obtaining a reverse mortgage, and what is the LTV
Oh yeah.
on that?
Was that from Lydia?
Yeah, Lydia said that. Uh-huh.
Lydia, what were your we talked about the LT, what were your questions about the caveats?
Oh, you already answered the LTV
Okay.
because I wrote some notes down, but the major caveats up front when a person asks us, unfortunately, we're going to be the experts because we're the first people they come in contact with.
Sure.
And they want to know what's the downfall to this. So, can you just
Oh yeah.
go over just two or three major downfalls up front so we won't be caught unawares?
Yeah, most definitely. The two big downfalls are, number one is if you never make a payment, which most people don't, the balance increases, right? So the balance on your home goes up, and you're going to make less equity when you sell the house or when you pass the home on to the kids. So really what they're doing is they're taking the future benefit and they're getting access to some of that today, right? So that would be one downfall, is whenever you sell your home, you're going to make less. And then the other downfall drawback versus having a home paid off, or as you guys know in the mortgage space, right? When you do a loan, there's closing costs. So just like there's title insurances and taxes and closing costs. In this scenario, probably the largest part of the closing cost would be the mortgage insurance. And the way that works, it's 2% of not just the loan amount, but of the appraised value. So, for example, if the home is a $300,000 appraisal, then the mortgage insurance is $6,000 that's rolled into the loan. Does that make sense? So it's 2% of the appraised value. So if they borrow $100,000, Lydia, then their balance on that scenario would be 106. Just like you would do an FHA mortgage, right? You finance the mortgage insurance in. In this scenario, they finance the mortgage insurance in the loan, but it's based off the appraised value, not the loan amount, if that makes sense. So that would be the biggest ones would be, hey, there are closing costs, and your balance in your home's going to go up over time. So that's one of the things that we'd work with you on to help analyze the pros and cons, because it may make sense for them just to go, you guys to do a HELOC for them, a line of credit, because it's going to be cheaper. They're going to those type of things. So that's what we help analyze. Does that make sense?
Yes. Let me ask you this question. Well, let me ask you, Monty had a question. He said, are you making less because of the compounding interest that's added to the loan?
Yep. So two things. Great question. You'd be making less because number one is if you have a paid off home or you have a small loan amount, we may give you some cash. So let's say you owe 50,000, we can give you 100, right? So you've got $100,000 loan on your house when you only had a 50 originally. So you're already making 50,000 less when your home sells. But then if you never make a payment, your $100,000 loan, you're going to be adding interest to that every month. So you may end up owing 150 or 200 on that home. So when you sell it, you're going to pay that loan off and you're going to make less. Does that make sense? So it's the amount you borrow plus the added interest would cause you to net less. So we help them analyze, hey, you would make all the money in 10 years when you sell it, but if you could get some of the money today, what would that help you do? Like we talked about earlier, right? The longevity, lifestyle, cash flow, paying your bills, giving some money to charity, those type of things.
Well, I want to ask you a question before I ask this last
Yeah.
one. Um, I remember when my grandmother got her loan. Um, she didn't have to pay any monthly payments at all, except for making sure that her insurance was paid and her taxes were
Yep.
paid. And she didn't have to do anything
Yep.
until, we didn't have to do anything either till she died or she moved out of the house and if we had to put her in a
Right.
nursing home. So there was years of non-payment that we went through until we had to put her
Yep.
in the home. Do they do that now? Is
Yes.
it?
Yep.
Oh, okay. Because each time I hear, I keep thinking that they're paying some type of monthly fee back to the mortgage company.
Yep. You're great question. So probably when she did it, she may not have even been able to make payments. One of the differences now is it's payment optional. So the people now could
Okay.
make a payment, whatever they wanted. Some people could just pay if they're really worried about their balance, they could just send in the interest every month. So that way the balance doesn't go up. It's like an interest only loan. But most
Mhm.
people don't pay anything. They pay zero because, like, remember the pastor I mentioned earlier? Well, he was tight on his money. He's making 4,000, spending 1,500 on the mortgage. So he's okay with a little interest being added to his balance. So
Mhm.
what your grandma was doing is there was interest, right? And her balance was going up every month, but she felt good because she was able to use that money to do other things with. So you're
Right,
correct.
because at the end we ended up selling the house and we still got a profit out of the house, even after paying off the money that she had got on the reverse mortgage.
That that's the
All
way
right, so
that's the way it
the
works.
last question is and I guess this shorthand, what is the current interest rate on the reverse mortgage?
Oh yeah.
Lydia, is that what you want to know?
Yeah, great. They're a little bit better than mortgages, and usually quite a bit better than HELOCs. Right now, they're between 6 and 7. So they're usually close to the mortgage rate, and then they're usually a little bit better than HELOCs are currently. So they're right there. One thing before we run, I'm gonna do what I'd love to do, if that's okay, is let you guys have if you wanted to do some education on this, I can put this in the chat. But my we do a lot of videos on YouTube, so it's called the Serving Senior Podcast. We have it on YouTube, Apple, all the different podcasts. But if you just looked up my name in YouTube and put Serving Senior Podcast, Matt Helton, you can find it, or I'll put it here in the chat. And feel free to check out the videos. Uh, I'll put it here in the chat. And then also too, we didn't touch on it as much, but we do reverse mortgage for purchase. So a lot of times a senior will want to sell their house because the house is too big, too much yard, multiple levels. But when as an agent, when you run the numbers, they're when they sell their home and pay off their mortgage, they're not going to have enough cash to buy the newer home, the one level, all the stuff that they want, right, to meet their senior needs.
Mhm.
So what happens is a lot of times the senior is going to say, Sharita, I thank you for spending 4 hours with me. Thank you for looking at all my pictures. Thank you for running all the comps, but I'm going to wait, right? And as an agent, I mean, you made
What
zero.
we do? Right, we're
You,
gonna flip them over and say, "Hey,
you made zero, right? And it may be in their best interest, right? Because a lot of seniors will say, you know what, I'm just not going to climb those stairs, and I'm going to tell John not to cut the grass anymore. We're going to hire somebody, and I'll promise you I'll stop going up the stairs. And then, a month later, you hear she fell down the stairs, or you hear that John
mhm,
passed out with heat stroke because he was mowing the grass at 80 years old. They are what they are, right? Most people don't change their habits. So it's probably not safe for them either. So that's why it's also good for the agent, but also good for the senior. So they sell their home, they make a stack of money, and then they put it down on a home. If it's a newer home, it may be more expensive, even though it's smaller in one level. And then we do a small reverse mortgage for the difference. So maybe the house they need to buy is 400, they clear 300, if you follow me, just like you do in all. So they put that 300 down on the 400, but the problem is either their credit's too low, their debt to income is too high, or what they usually tell you, Sharita, is like, at 7% and $1,000 mortgage at 70 years old, I just can't do it. So we're going to wait till rates go down, and nothing ever happens, right? We've been waiting
rates
for rates
never
to
go
go down
down."
before down. So that's where sometimes the senior go, you know what? I'll relook at this because you telling me I can move, even though I have a loan on my house, I have a zero required payment. Okay, that may make sense. So that's what we talk about in our 3 hour CE class that we want to do for you guys, is how you can strategize with seniors to be able to say, hey, here's how you can downsize and still have some money in the bank and have a zero monthly mortgage payment.
Sounds good.
So I hope
Matt,
that
this
all
has
makes
been
sense.
an interesting class. I love the information. I think I got a lot from there, so it may be another little caveat that I promote for seniors because, I kind of got a little bit of experience, but you got some new stuff that you guys I got going. But I think that this has been a pretty good class, and I really love it.
Thank you for
Any
saying.
other questions or concerns, ladies, gentlemen?
Very informative. Thank you.
You're welcome. And Matt, thank you so much for taking the time to teach us. And we look forward to that CE class in September.
Sounds great, guys. You can see my number on the screen. I just put it here in the chat, and we do a lot of Jack and Jane Doe scenarios. So feel free to call and say, hey, I got a client. She's 67. She owes this much. Her house is worth this much. What would it look like? And I can punch it in for you, give you the knowledge. You could chat with them. We're here to help. Our whole goal is to make sure they're taken care of. Sometimes it's best they're taken care of at the bank with a HELOC. Sometimes it's best that they do a 30-year fix. Sometimes it's best for us to do this, but rest assured, that we're going to advise them on what we would tell our grandma or mom or dad to do, not what's going to make us money, because we know if we give them the right advice, it's all going to come back to us in the end. So we're so glad to be here and so glad to be able to help your friends and clients and family members.
Thank you so much. We really appreciate you.
Thank you.
Thank you.
Thank you. Thank you guys so much.
And we'll see you in September. Thank you,
All
sir.
right. Take care.
All right. Bye-bye.